Hey everyone, welcome to the first video of the Financial Accounting and Reporting module. In the first video, the first chapter is talking about the fundamentals of financial statement preparation. So this is as an accountant in a business or perhaps in a public practice organization where you're preparing financial statements for clients. This is the subject that applies to that. So understanding the financial accounting standards, understand how to read and present and prepare a financial statement. So let's first of all talk about the accounting standards and how to navigate them. So essentially, the accounting standards are one of the key resources accountants refer to when preparing or reviewing. And essentially what it is, it's a framework in order to prepare financial statements. So it has all the rules in terms of how to treat certain things, what are the things you need to include, including kind of notes, and it's basically this all-encompassing framework. So it's important when you're preparing, because if you're not sure how to account for something, for example, you could refer back to the standards, or if you're reviewing, what you could do is have a look at what someone's provided to you and then compare it against the financial statement, against the standards, and say, have you included this note? Have you accounted for this part correctly? So the IASB issues implementation guidance examples and basis for conclusions as part of the IFRS standards. So if there's difficulties in applying the standards that are set out, for example, it's not always super clear how to actually interpret them and apply it, what they do is the IASB board basically issues interpretations. And these are basically, PDFs that you can access online that give you additional context and detail as to, for example, IFRS 16, how does that actually work in practice? What are the common problems and what's our view where it's not exactly clear? So if there's no relevant standard, the principles and criteria within the conceptual framework apply. So what this means is essentially the accounting standards are, whilst they do cover specific areas and tell you how to do specific things, ultimately what it is a conceptual framework, which basically means that it's a framework to apply to any given situation. So it's more about principles on how to approach the situation so that you can then apply that without necessarily applying to one particular thing. It could apply to all kinds of scenarios. Okay, so elements of an accounting standard. So this is more talking about how it's actually structured in the accounting standards. So how it's structured is it has these different key elements. So it's got the content page, the objective, like what's the standard actually trying to achieve. Then it's the scope, so which is basically which transactions are specifically excluded. Then definitions, which is kind of the key terms used within the standard. Then requirements, which sets out specific accounting principles, choices, rules, etc. And then disclosure. And this is talking about how much information you actually have to present in the accompanying notes and also in the financial statement. So, do you need to provide extra information to the readers for this particular topic? So in terms of appendices in the accounting standards, typically has defined terms. Obviously that's self-explanatory. Application guidance, which is bit more qualitative stuff explaining how it might actually be applied. Some examples of it in practice, and then a basis for conclusion, which is basically explaining the reason for the accounting standard and basically the standard's objective, requirements, and disclosures in summary. Okay, so 1.2, which is the structure and content of financial statements. So this talks about what is actually in the financial statements, what is needed to be included in terms of structure. And at a very high level, and you probably already know this by looking at financial statements before, but essentially there's certain key categories which inform what reports are shown. So by default, we need to show how the income of the business is. So it's a statement of financial performance. We need to show the assets and liabilities of the business, which is called the statement of financial position. And we also need to show changes in equity, i.e., the cap table, which is called the statement of changes in equity. And finally, what is the cash flows of the business changing, which is the statement of cash flows. And ultimately, those four key areas are what you need to really understand to analyze a business. So how profitable it is, what's the strength of the balance sheet, and if there's any solvency issues there. what's the equity situation in terms of funding the business, and then finally how much cash is being generated out of the business, because income doesn't necessarily translate to cash flow, obviously due to accounting standards. So cash flow is also important to understand what's the impact on the cash going forward. And then, so that's the financial statements and the key reports. But then in addition to that, the second kind of structural element of that is around the notes. And this is basically additional information that might be needed in order to explain certain things. So it might be needed to explain which accounting policies have been applied, how professional judgments and estimates have been applied, and provide any further detail around kind of, specific account balances, or specific cash flows that roll up at the total level to get to those statements. So the relevant standard that actually talks about presentation of financial statements is essentially IAS 1, and this is basically talking about how do you structure these reports, what's the minimum content of these reports, what are the minimum reports that you need to include, right? So this is essentially talking about in detail what we talked about at a high level earlier, which is you need at the very minimum these reports and you need these notes. And this kind of goes into more detail. So the first one is, at bare minimum, you need a statement of financial position, which is essentially another word for the balance sheet, but in financial statements, we call them statement of financial position, or SFP. And within IAS 1, they talk about, things like setting out the rules for how do you differentiate between current and non-current assets. So the definition for that is assets are essentially current if they are cash or a cash equivalent. They're held for trading. So this could be like a stock or a bond or something that you're holding to actually trade rather than holding to maturity, and expected to be realized within 12 months or the entity's normal operating cycle. So for most businesses, it's just this, less than 12 months. But technically the full definition, it also includes the company's normal operating cycle. So there could be, it could be instances where technically, you could argue an entity's normal operating cycle is 13 months, and it could actually be defined as a current asset. So any other asset which falls outside one of those three is classified as non-current. Liabilities is a little bit different in terms of the definition of current versus non-current. So for current, it's either they have an unconditional right to defer settlement beyond 12 months, B, they are held for trading, or C, expected to settle within 12 months or within an entity's normal operating cycle. So it's kind of similar to the asset side, but it's just the inverse of it for liabilities. The only one that's slightly different is this top one, which is basically talking about unconditional right to defer settlement beyond. So there's no right to basically defer it beyond 12 months. So again, it's talking about this less than 12 months concept. And then similarly, if you're outside one of those definitions, then it's just deemed as to be kind of non-current. When looking at equity, so obviously we've covered assets, we've covered liabilities. The only other component to a balance sheet or a statement of financial position is equity, because as we know, assets minus liabilities equals owner's equity, or equity. So the only requirement worth noting here, or the main requirement worth noting here, is under IAS 1, it essentially asks you to split out the equity attributable to the parent entity's interests, which is basically, think about, if Microsoft owns, they're just acquiring Activision. So they're going to acquire Activision, they own a majority right of it, they would be the parent entity. But a non-controlling interest is one which is either less than 50% interest or doesn't have a controlling right in the business, like doesn't have control over the business. So if this business has, 30% ownership, it's probably non-controlling interest. So basically, you just have to split out the equity between parent company, so majority owner, and non-majority owner, essentially. So IAS 1 also requires several lines to be included in the financial statement, but additional items are also allowed. So this is kind of like a minimum requirement to set out, but then beyond that, you also set out additional line items. So this is like specific current assets, like prepayments and things like that. And it also includes a few disclosures and disaggregation that's required either on the face or of this statement of financial position or in the notes. So statement of profit and loss or other comprehensive income. So this is, you probably associate this with your P&L, right? In management accounting, we just call it P&L. Within, preparing financial statements, we call it the full name, which is statement of profit and loss and other comprehensive income. The reason it's different is because, again, there's very specific rules which apply to a SPLOCI versus a management P&L, which can kind of look however you want it to look. Whereas SPLOCI and statement of financial position have specific rules as to which accounts need to be included, how it's split out, what disclosures are associated with it, etc. So the SPLOCI, if I ever call it P&L for short, just know that it's the full name. I'm just saying it to make it a bit shorter. So in actual practice, this can be presented on a single combined statement with two components, right? AKA your profit and loss component, and then other comprehensive income components. We'll talk about what they mean in a moment. So the profit and loss component is pretty self-explanatory. It's similar to what you'd see in a management P&L, but it's got very specific categories. So these are revenue, finance costs, gains or losses arising from derecognition of financial assets, impairment losses, share of the profit or loss of associates and joint ventures under the equity accounting method, gains or losses from financial asset reclassifications, tax expense, and single amount relating to discontinued operations. Noting that the last one is outside the scope of this module. So what each of these mean, we'll cover it in more detail later, but essentially revenue is pretty straightforward. Costs are pretty straightforward. It's costs related to any finance things, like maybe a loan issue, things like that. Gains or losses from derecognition of financial assets measured at amortized costs. So we'll talk about financial assets later, but these could be things like, bonds and things like that. If you're derecognizing them, basically, writing them off or selling them essentially. Impairment losses. So impairment losses, we'll probably talk about this later, but essentially what it is it's similar to depreciation, but it's for intangibles. So it could be things like brand name. It could be for, acquisitions, like if you've acquired goodwill in a company, which is an intangible on the balance sheet. When you write these things down, instead of it being called depreciation, like it might be on a fixed asset, we call it impairment. But you can also reverse impairment losses and impairment gains as well. Next is the share or profit or loss of associates and joint ventures under the equity accounting method. So similar to what we talked about earlier, where companies can have different levels of ownership. They can be majority owners. They can be joint ventures where it's kind of 50-50, or they can be minority owners, right, where they own a minority. Depending on which one you're classified as is going to impact how you basically consolidate any minority interest in your financial statements and P&L. The reason is you're only allowed to consolidate up 100% of of acquisitions if you own majority control. So that basically means if you own 51% of the company and you have control, you basically consolidate 100% of the numbers. So you're showing 100% contribution. And then there's a section at the bottom where you actually reverse out the section that you don't actually own. Joint ventures and minority interests, you don't actually show the full contribution like that. You actually only show the net contribution. So you figure out what is your percentage ownership of that company's kind of net profit, and then you show that number. So this section here is really talking about how do you actually, where do you account for those minority interests, joint ventures, etc. Next is gains or losses arising. Oh, and just as a note, we don't actually cover this section in the scope of this subject. It's more just for background information. So the next is gains or losses arising from financial asset reclassification. So we'll talk about this later, but essentially you can reclassify financial assets, and that's going to impact how you account for it and may also result in kind of a gain or a loss at that point in time. Next, tax expense. That's pretty straightforward, self-explanatory. And then any single amounts related to total discontinued operations. What this means is essentially in the name, like if you have a business offshore or a startup or a greenfield, and let's say it goes bankrupt, you essentially close it down, you discontinue it, right? So that's when you basically isolate any amounts. which relate to businesses or investments, etc., which aren't going to be there anymore. So that's the first part of the statement of profit and loss and other comprehensive income, so the profit and loss component. So the second component is the bit that people probably struggle a bit understanding more so than the P&L, which is the other comprehensive income component. And the reason we have to split this out is because there's certain accounting standards which don't allow certain items to be included in the normal profit and loss. And they're treated like that because they're quite different items. Either they either they have an unusual nature and needs to be isolated from the underlying business model, or for other reasons. So basically we group them into two categories within OCI. The first one is, well, basically one or two are whether or not they're going to be reclassified to P&L at a later date. So depending on the accounting standards for each item, there may not ever be reclassified to profit and loss because of the nature of the item, or there is a chance that they may be classified back into profit and loss. And we'll cover this in more detail later on. So similarly, expenses are also classified into two components. So number one is the nature of the expense, and then the second is the function of the expense. So these are essentially two ways to basically classify expenses in the profit and loss. For example, how do you split out all the different costs in the business? Like how do you split out advertising and rent and salaries? So do you do it by the actual nature of it, which is how we described it earlier? So what is the actual cost? Like how would you look at that cost individually? If this is Google ad spend, that's obviously going to be advertising, right? So that's going to be the nature of the spend. The alternative is relation to the function of the expend. And that could be around what those expenses are actually doing, like what's their function. So some examples of this could be cost of goods sold, distribution, and administrative costs. So if you've got a warehouse cost, right? If it's nature, then you could say this is like, rent and facilities, right? Rent and outgoings. Whereas if it's warehousing in relation to a distribution channel in the business, you could group it in with other costs which relate to their function, or what function they do in the business, rather than the individual expense. In this case, that might be a distribution cost. So basically, those two different components impact how you might actually report and lay out some of these costs in the profit and loss. Okay, so next we're going to talk about the single statement versus the dual statement. So there's no requirement under IAS to do either a specific format for the SPLOCI. Instead, it requires the SPLOCI to include both the profit and loss and the other comprehensive income. But you can essentially do this in one of two ways. Number one, you can just do it as a single statement, right, which is called the single statement approach, and this will just have your P&L and OCI together, all in the single report. Or what you can do is the dual statement approach, which essentially, first of all, it presents the income and expenses under the P&L, and then you have a separate statement, which is called the statement of other comprehensive income, which starts off with the profit and loss from the previous page and then works backwards from there. Okay, so we've talked about the statement of financial position, which is your balance sheet. We've talked about the SPLOCI, which is the equivalent of your P&L. And then the final one, not the final one. The next one is statement of changes in equity. And this is really looking at the equity, which is normally found on the balance sheet of a company and displays how the company is actually funded in terms of equity. So you might have had, for example, equity from certain shareholders, which is your share capital balances, but it could also have these what's called balances and reserves. And these are basically, they're not actual cash changes, rather they're these balances which are calculated using accounting standards, which is like a balance for the other side, which could be, let's say you increase the value of a unrealized asset. So the other side of that is probably going to go to your FTOCI reserve, which is your fair value through other comprehensive income reserve. there's no cash associated with this, but it's basically just a balancing to one side of the accounting journal. And the reason for this is because we haven't actually sold the asset yet, but we're revaluing it upwards. So the other side needs to go somewhere. Well, it's going to go in equity because eventually when we do sell that, it's going to come out of that reserve and go back paid to shareholders through either retained profits or dividends, both of which are equity accounts. So some other examples of things that might fall under balance and reserves could be revaluation surplus, again to do with when we're revaluating assets up or down. It's a balancing item which sits in equity for similar reasons to the FTOCI reserve we talked about. And another one could be foreign currency translation. They're all kind of following a similar basis where they're reflecting a future change in value which hasn't yet been realized. We need a balancing item because it's not going to be in cash, so it's going to go to equity. So that's why we have those two main categories, which is share capital, balances, reserves. And the final one is retained earnings or accumulated losses. So this is essentially profit or loss for the accumulated period, which hasn't been paid out, right? So the current period, plus any dividends or transfers to and from the reserves, right? Because dividends is going to be coded to there. It might actually reduce the amount in this period, so it might actually reduce retained earnings, but ultimately all of these three things factor into your what's sitting in retained earnings. So movement for each component of equity are separately disclosed, so P&L, OCI, transactions with owners, retrospective adjustments on changes in accounting policies and material errors. So these are disclosed as a note. And the total of such movements would be equal to the change in entities' net assets to the period. Okay, so the next and the final kind of key statement that needs to be included in financial statements is just statements of cash flows. This is really showing how the entity is generating cash, right? So basically it needs to reconcile your opening cash versus your closing cash. That's the movement during the period. So what this report essentially is breaks down that movement during the period into three different categories, which is your operating activities, investing activities, and financing activities. So your operating activities per IAS 7 is basically your main revenue generating activities of the business. So what does the business actually do? What is its purpose? If it's a building company, then it would be from selling buildings and collecting, paying for the core materials for the buildings. Investing activities is to do with specifically the acquisition or disposal of long-term assets and other investments. And the reason this is split up from operating activities is because when you're assessing a company, you want to know what the core business is doing, right? And want that split out from any like non-recurring, one-off, very large things. Otherwise, this can distort your understanding of what, how cash profitable the underlying business actually is. And then finally, financing activities. So these are things to do with borrowing. So if the company is taking out debt or raising equity, so if it's doing kind of like a capital raise in the markets, any costs and transactions associated with those two key areas. Again, the reason for doing this is to split out the core business activity so we can understand that and it's not distorted from these other things. Now, when you're preparing, if you've ever had to prepare a three-way model in Excel, which is basically preparing those three statements, so essentially your balance sheet, your cash flow, and your profit and loss. Obviously, different name for financial statements, but I'm just talking about modeling. You'll understand that each of those statements link together. And I guess sometimes you do a statement of changes of equity, but for most three-way models, you can ignore the statement of changes in equity because it's already kind of picked up in the balance sheet. But you'll know that there is a correlation between all of them. For example, in your P&L or your SPL OCI, the business is showing its revenue, expenses, profit, right? That profit or excess profit flows through to the statement of financial positions in terms of your equity, specifically your retained earnings. Similarly, this also the net profit forms the basis for your statements of cash flow, specifically the operating section of your statement of cash flow, right? Your balance sheet will have things like cash, which is linked to the closing balance of your statement of cash flow, right? Because we know that opening and closing cash needs to rec to the statement of cash flows. So there's various other things that link between them. For example, maybe investing activities, could be the balance sheet or P&L related items, but ultimately the key message is they all flow through and are all related. Okay, so let's talk about the next section, which is measurement in financial reporting. So when you're preparing financial statements, you need to select a unit because this is how you actually measure things. For example, if you just have numbers, how do you know if it's Australian dollars? How do you know if it's US dollars? Depending on what's chosen as a unit of measurement will vastly change the numbers and understanding of what numbers are being presented in the financial statements. So all of this measurement concept is covered in IFRS 13, and this provides guidance for measuring the fair value of transactions and events. So fair value is a key concept, and this is essentially the price that will be received to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. And this is important because certain assets and liabilities are required to be reported at the fair value. And fair value can be hard to determine if you're still holding the asset and it's not like a share on the stock market, which the fair value is determined all the time. It can create some complexity if it's something like land, because, how do you actually know how much land is worth? Or it could be, a different kind of asset or liability. It could be like a derivative. How do you actually value a derivative? It can be very complex financial instruments. So because fair value in certain types of assets can be difficult to determine, that means that there can be an area of judgment. There can be areas of judgment about other things, but we're specifically talking about fair value right now. So where are some key areas of professional judgment for fair value? So number one, what unit are we actually accounting for? So what level are we talking about the asset? Are we talking about the factory? Are we talking about the land and the factory? Are we talking about our geographic investments in Queensland, right? So it depends on which level we're talking about the asset or liability is aggregated or disaggregated. Okay, so next is determining the exit price. So we know from the definition of fair value, it's essentially the price that will be received to sell an asset, i.e. the exit price, in an orderly transaction. So for a transaction to be orderly, it does mean that it's not a forced transaction, because obviously, if you're a company that is going to be around for a long time, they can sell an asset over many years versus, after the GFC, many banks left the country. They did kind of fire sales of certain investments because they had to exit. They needed to do it quickly, which meant that would have been a forced transaction and wouldn't necessarily have been a reflection of fair value. So the value of the assets they sold would have been different if they'd stayed around long term versus if it was a forced transaction. So we need to consider that. So forced transaction doesn't necessarily mean fair value. Next, a key concept within IFRS 13 talks about the need that it's the principal or the most advantageous market when defining what fair value is. So when we're looking at market participants and what the market would pay, which is in the definition of fair value, we need to consider what is the actual level of the market, because there can be different levels of markets, right? So for example, if you've got listed stocks, there's only one market, right? It's the ASX. It's very easy to determine the value. But if you've got a plot of land in the city, the market could be property developers. It could be people who want a land bank. It could be farmers. It could be people who want to build a commercial property on it. It could be people who want to build a wind farm on it, right? So there's all these different types of markets and different purposes. And ultimately what we need to do is find the most advantageous or principal ones of these. So principal is essentially the market with the greatest volume and level of activity. So it could be for cars, it could be, carsales.com.au. And it's the market that an entity would normally enter into to sell the asset or transfer the liability, unless there's evidence to the contrary. If there's no principal market, it's the most advantageous market, which is basically the market that would result in the highest possible price. So again, going back to that example of the different markets I used before, which one of them would actually result in the highest price. Would it be carsales.com.au? Would it be posting in your local newspaper? Would it be going into a local dealer and getting the price there? Well, it's probably going to be car sales because that has the greatest volume. Next to consider is market participant characteristics. So we need to consider whether the buyers and sellers are actually independent of each other, knowledgeable, able to enter into a transaction, and willing to enter into a transaction. If you have market participants who aren't actually knowledgeable about the asset and you ask them what they pay for it and they say $10 million, but if they actually did their due diligence and they knew more about it, maybe they realized there were certain issues with it, they'd actually say, okay, it's probably $2 million given that. So actually the true fair value is if they had known all of the information and were willing to enter the transaction. So it would be actually 2 million rather than the 10 million. So next is considering the highest and best use. This basically means looking at all those different market participants and saying, what is their intention? So I gave the example before about some wanted to build a shopping center, some wanted to build an apartment. Depending on the profit level of each of those people, they would have all had their own different purpose and their own different willingness and capacity to pay a price for the asset. So you actually need to look at all of the different intentions. So if it's land, you need to discuss with all those different parties with different intentions and say, how much could you pay for this? How much is financially feasible based on your strategy? And then you basically take the highest out of all of those. Next is evaluation techniques and processes. So basically the person who's applying judgment to a fair value needs to consider the valuation technique, right? So there's the particular for businesses and things like that, there's various ways you could value it. For example, you could be a discounted cash flow, right? Looking at future cash flows and discounting it. It could be a valuations comparable analysis. So looking at kind of precedent transactions, figuring out what others have paid for similar assets and applying that same multiple to EBITDA, for example. It could be looking at the value of the assets and just kind of comparing all of those. And the highest one might be, application of a multiple. So, but you do need to consider which is appropriate. Is there sufficient data? Is there observable inputs? Are there any unobservable inputs that need to be minimized, and so forth? So a key distinction IFRS 13 is between observable inputs, which is basically market data, and also unobservable inputs, which would reflect the entity market's participants. For example, inside knowledge that a certain group isn't acquiring at the moment. So even though we think they'd pay this, they probably wouldn't be a participant, which would actually drag the price down. That's probably a good example of unobservable input. Observable inputs could be the multiples that have been paid on precedent transactions, because we can get the data from CapIQ. We know exactly what they've paid historically. And IFRS 13 basically says that regardless of which technique is being applied, it should maximize the observable inputs, because this is very easy to link to data and prove it out, and minimize unobservable inputs because these are more unreliable because they can't be linked to data. So next is the hierarchy of fair value. So essentially there are different levels of fair value depending on how reliable they are. And basically level 1 inputs are basically the most objective, as it relies on unadjusted quote prices in an active market. So a good example is the ASX. We know exactly at every given minute what people are willing to pay for a particular share. So this is a level 1 input. It's highly reliable. But the further down you go in terms of the inputs, they become less and less reliable. So level 2 inputs could be relying on observable information, decisions about compatibility. So could be like looking at carsales.com.au, and you can see similar models, but maybe they've done different, tens of thousands of kilometers. Maybe one's manual, one's automatic. Maybe one is, different color, one's convertible, etc. So there's all these different, kind of, like they're the same model, but depending on what's impacting them could have vastly different impacts on, what valuation you're kind of applying. So a 10,000 kilometer car, which you're comparing, might be listed at $20,000, but you've got a $100,000 kilometer car, which wouldn't be at the same price, and it's not fair to talk about it at the same price. Okay, so level 3 inputs are the least reliable, and these are basically unobservable information which requires complex professional judgments about assumptions and risks. So this could be looking at a business and trying to figure out what the value is, and you kind of have to look at comps. You have to get a professional valuer in. You have to kind of do all the analysis and figure out what do you think people would pay for it. But it's not very reliable, ultimately, at the end of the day. And the final step is to actually determine the fair value. So it's pulling all these things together and understanding the specific definition, which is that it's a price that would be received to sell an asset or pay to transfer for a liability in an orderly transaction in the principal or most advantageous market at the measurement date under current market conditions, regardless of whether that price is directly observable or estimated using another valuation technique. So it's a long definition, but each of those different components of the definition can be split out into one of these sections. So hopefully that all makes sense now. Another thing to note is that when you actually measure this exit price, IFRS 13 actually specifies how to treat certain transaction costs. So transport costs is one example. So transport costs is basically when you include transport costs and transaction costs. So transport costs are actually getting the asset that we're selling to a different location. So if we're buying a windmill that needs to be transported back to a different farm as part of the purchase, that would be a transport cost. Whereas transaction costs are things like you have to appoint advisors to help you value it and sell it. Therefore, that's a transaction cost. So IFRS 13 basically says when valuing fair value, you need to include transport costs because that's kind of relevant to the fair value. Like if you have to transport an asset, obviously an asset that's far away is going to reduce the value of what people are willing to pay for it, versus transaction costs are excluded because they're not to do with the actual asset itself. They're more to do with the transaction rather than the inherent function or nature of the asset. So disclosures under IFRS 13 are extensive and they're grouped by recurring disclosures or non-recurring disclosures. So it's pretty self-evident as to what both of these mean. Recurring disclosures are basically ones which you need to do on a recurring basis, i.e. at the end of each reporting period. Whereas non-recurring ones are those that you only need to do at one point in time in a particular circumstance. So IFRS requires disclosure to the effect of the measurement for the reporting period on profit or loss or other comprehensive income, where recurring fair value measurements use significant level 3 inputs. So it's only relevant if you do a lot of the level 3 inputs. Also, for any items in the SFP, fair value after initial recognition, it requires an entity to disclose by asset or liability the level in that fair value hierarchy at which the fair value's measurement is categorized. So present value is often part of the fair value measurement, i.e. you do basically a DCF, discounted cash flow. You calculate all the future cash flows up to a terminal point, then you discount it back at the discount rate, and that's basically the present value. So another key concept is materiality. So it's around whether the transaction is material or not. And a transaction could be material if it's if you misstated that, or if you obscured it. It could be expected to influence the decision of primary users. So if you were to not include a change in valuation or a certain transaction, would that actually impact the decision of primary users, so investors, management, etc.? So if it does, then it's material. If it doesn't, then it's immaterial. So there's a practice statement relating to IFRS, which is called Practice Statement 2, which is similar to those extra guidance documents that we talked about earlier, which basically gives you additional guidance to accountants on how to make materiality judgments. And there's basically 4 key steps. Identify any information that's got the potential to be material. Number 2, assess whether the information is in fact material. Number 3, organize the information in a way that communicates the information clearly and concisely to primary users. And then review the draft financial statements to determine whether all material information has been identified and materiality considered. Okay, so let's move on to 1.4, which talks about accounting policies, estimates, and errors. So with accounting policy, with financial statements, as we discussed earlier, there's a lot of potential areas where it's not clear and that the numbers could change depending on how you actually approach it. And these are things like accounting policies. So this is, the practices, the rules, the conventions. For example, how do we actually apply valuations? Estimates is where a judgment has been applied by an entity when applying a policy, right? So the policy is the framework. The estimate is an actual application of that framework in calculating a number. So we've estimated the effective life of an asset to be 6 years, for example. Or we've estimated that we expect 1% of our sold products to come back as warranties, right? That's an estimate. Or the final category is an error, and this is really not necessarily a failure of an estimate, rather it's an omission, so you haven't said it, or a misstatement, like you've said the wrong number due to failure to use, or maybe you've misused information. So there's a specific IAS accounting standard called IAS 8, which covers these areas: accounting policies, change in accounting estimates, and errors. So there's this hierarchy model which tells you basically how to approach it depending on what's happened. So the first one is there a standard that specifically applies to the transaction? If it's yes, then you apply that specific standard. If no, then you use judgment and apply a policy. So obviously, where there's a specific standard, it's going to tell you exactly how to approach a situation. But as we discussed earlier, the standards are a framework. Sometimes there's general terms or guidelines in, for example, depreciation. Some general guidelines in terms of how to figure out how long an asset's effective life it is, what type of asset it is, whether you should be depreciating it at all, right? So there is judgment in there. So then what you need to do is consider, okay, so it must be relevant to users and reliable. Also consider the conceptual framework and if there's any related issues in the standards. And finally, consider any recent changes in jurisdictions, any literature on this topic, any accepted industry practices on this topic. And once you've considered all of these things, you're in the best position to make an most accurate as possible, accounting policy or estimate. Okay, so this is just talking about what we just mentioned in that diagram. So the following flowchart details the summary of professional judgments required under IAS 8 when changing an accounting policy. So first, does the event demonstrate the characteristics of a change in accounting policy? Yes. If no, not classified as a change in accounting policy. So this is more like a scenario where the firm is changing its accounting policy from, say, 6 years depreciation policy to 5 years, right? So first of all, does it demonstrate change in accounting policy? Yes, it does. Is the change in accounting policy for a different transaction or other event or condition? No, it's not. Is the change in accounting policy for an immaterial transaction? No, it's not, because it's to do with material transactions, which might influence an investor's decision. So there's no. Is the change in accounting policy for the first adoption of the revaluation model under IAS 16? So this was a new standard, and it had a specific statement talking around initial adoption. So that's very specific. We can ignore that. No. Is the accounting policy change required by the initial adoption of an existing IFRS standard? So this is more talking about they're adopting a specific standard as opposed to a general kind of a general estimate or policy change. And then finally, account for it in accordance with IFRS standard transitional provisions. So where the change is made because of a new or revised accounting standard, the date of application will be based on the details in the standard. Where the change is voluntary, retrospective application is required, as if that policy had always been applied, unless it relates to a first-time valuation. Where an accounting standard has been issued but it's not yet effective, the entity must disclose this. IAS 1 provides guidance for the disclosure of significant accounting policies and requires the companies to disclose the measurement basis used to prepare financial statements. Accounting estimates. So accounting estimates are the judgments an entity makes when applying an accounting policy. So we talked about this earlier, how a company might have a specific kind of depreciation policy, but then it leaves up to the accounting team, depending on what type of asset it is, to actually make a judgment as to which effective life and whether it's straight line or accelerated depreciation policy, right? And that depends on the type of asset it is. So the risk is that management could get it wrong, but ultimately what they have to do is basically take the policy and make a best decision from this. So within IAS 18, they actually set out like certain examples of where there may be an accounting estimate taking place. So for example, if there's an expected credit loss from inventory obsolescence, or if there's a fair value of financial assets or financial liabilities, because obviously, the accountants are going to have to estimate to the best of their knowledge the fair value of that asset. It could be around the useful lives of depreciable assets, right? As we talked about a moment ago, when we acquire a fixed asset or other depreciable asset, the time period that we need to depreciate that asset may change depending on what type of asset it is. You're basically trying to estimate how long we think we're going to have this particular asset for before replacing it. And finally, warranty obligations. So, how many of the widgets that we're selling we're expecting to come back as warranty claims. So a change in an accounting estimate is basically looking at an estimate that we've applied before and then reassessing it. But fundamentally what it is under IAS 8 is a reassessment of the carrying amount of assets or liabilities due to the changes in the expected future benefits or obligations of these items as a result from new information or developments. And this could be because the transaction originally, the estimate couldn't be measured accurately. This means that, so it's not an error, right? Because it means that the original estimates were correct at the time they were made, and that, something else has happened, right? So maybe, you've purchased laptops and you assumed a 5-year depreciation period or useful life. And then what happens is the technology becomes a bit more obsolete and people are all of a sudden using iPads instead of laptops. So all of a sudden we're going to go back and revise the useful life of our laptops to 1 year because of this new change. Now, this doesn't mean that our original estimate of 5 years was wrong or an error. It just means that there's new information, new technology, something changed, and we're going to go back and reassess it. And this means that we need to, the carrying amount of those assets, which is, the carrying amount is basically the cost less your depreciation of the period. That's your carrying amount. And that means we need to reassess what that carrying amount is. So instead of, we've only depreciated 1 year out of 5, when in reality, we probably should have depreciated 100%. So we're going to change that carrying amount from 4/5 to 0. So that's a reassessment. And this is a big difference to an error, right? Because an error is where, we went back and we said 5 years. And why did we say 5 years? Oh, that was the junior accountant. It shouldn't have been 5 years. So this is an omission or misstatement. In this case, in the example I gave, it would be a misstatement relating to one or more prior periods because of not using or misusing reliable information at the time of preparing and authorizing the financial statements. So this could be for various reasons. It could be due to a mathematical mistake. It could be because of misapplying or misunderstanding the accounting standards. So how we actually adjust for these depends on whether the issue is material or not. If it's material, prior periods are adjusted retrospectively in the first set of financial statements issued after they're identified. In the comparatives, if this is when the error occurred, the opening balances of the earliest year of comparisons are adjusted. Retrospective adjustments for errors are accounted for the same way as changes in accounting policies. So when a retrospective adjustment is made, an additional comparative statement of financial position is required. If a retrospective application is impracticable, i.e. it's not really practical to do, the entity just restates the opening balance for the earliest period that the retrospective restatement is practicable. Furthermore, you also need a disclosure in terms of the nature of the error, the amount of the correction, to which financial statement line is its impacts, and earnings, and the impact on earnings per share if it's applicable. So basically got a diagram here which tries to summarize all those things. So obviously the three kind of things covered under IAS 8 is the policies, estimates, and prior period errors, with a definition of what each of them are, and then basically what tasks, what actions you need to take. So for example, follow specific transitional requirements or retrospective application to adjust prior period if there's no specific transitional provisions that apply. In other words, if there's a specific code in the standards which says this is a new standard, in the meantime this is what you should do during the transition period. If that doesn't apply, then what you need to do is basically retrospectively adjust prior periods for the policy and also disclose it in the notes. If it's a change in accounting estimate, you only need to adjust the current and or future periods. So you don't need to adjust the historical periods and disclose it in the notes. And then for prior period errors, you need to adjust the prior periods retrospectively and disclose it in the notes. This is for material errors. If it's immaterial, you don't need to do that. Okay, cool. So that's the end of video 1. Hopefully you found that useful. See you in the next video.